I dealt with all the headaches. I dealt with all the nightmares of owning a rental property with tenants that live there. And I was like, never again. So once I discovered this type of commercial real estate where, the taxes, the insurance, all the maintenance, it's hands off to the point where I don't even have keys to the building. That's where I was like, this is it. And this is the asset class we're focusing on.
From cornfields to high-rises, office to industrial, houses to hotels, and every other asset class in real estate, we cover the people, the projects, and the profit. Welcome to the Investing in Iowa show. This show is for go-doers, action takers, and business owners. It's for people like you who are sick of Uncle Sam taking a huge bite of your apple. If you're looking to get ahead of what's taking place in Iowa, learn who is doing what, and how you can get in on the action, you're in the right place. Hosted by Neil Timmins, an Iowa native who has been involved in over $300 million in real estate right here in Iowa. Recording in studio from West Des Moines. Here's your host, Neil Timmins.
Tom Rauen back on the show. Tom, welcome.
Yes, good to be here.
I'm excited to have you back on the show. Say, for the audience sake, remind them, who are you, where are you from, what do you do?
Yes, Tom Rauen with Rauen Capital and fast food landlord based out of Dubuque, Iowa, and specialize in investing in net lease commercial real estate.
All right, net lease commercial real estate. Let's expand upon that. Then I want to bring people up to speed. It's been a year or so since you've been on the show. Net lease commercial real estate, what asset classes?
So variety of asset classes. We've got some industrial, we've got some flex industrial, we've got medical, we've got some restaurants, some quick service restaurants, fast food, some strip centers. So basically anything that's commercial, non-office, non-people living, typically high traffic locations, national tenants, long-term leases, and typically triple net. So we want the tenant covering the taxes, the insurance, and all the maintenance. So we like it very passive, very hands-off, and we try to keep it simple and easy.
Have them cover all the variables, right?
Yeah.
Fast food landlords, what's that?
So fast food landlord is kind of what we just coined the name of it, because most people drive down the street and they don't realize that you can own Starbucks and Arby's and Applebee's and all those things. And so it's that intro into, this real estate asset class. Most people, when they think of investing in real estate, they know like, all right, I've got this job, or, we've got some money in a 401k, or we're investing in the stock market. And then somewhere along the lines, they listen to a podcast or they saw on Facebook that they need to invest in real estate. And the first thing they think is, we got to buy a single family home and rent it. We got to buy a house and rent it out, or maybe a fourplex and rent it out. Or right now it's, the hot thing is an Airbnb. We got to get an Airbnb somewhere and rent it out. And what most people don't realize is that's actual work. It's a lot of work, right? And the returns aren't there. And I'm not like a super handy guy. So I'm not one to go and fix up things. And when something breaks, I don't want to have to deal with it. And so this asset class of the triple net lease, where you've got stabilized tenants, long-term, 10, 15, 20-year leases, and your tenants are Starbucks and Arby's and these big Fortune 500 companies. I mean, these big national companies, I know they're going to pay me rent every month versus, the college kid or whoever else that's like, oh man, are they going to pay rent next month? And, their lease might be only 6 months. And that was my very first property. And I dealt with all the headaches. I dealt with all the nightmares of owning a rental property with tenants that live there. And I was like, never again. So once I discovered this type of commercial real estate where, the taxes, the insurance, all the maintenance, it's hands off to the point where I don't even have keys to the building. That's where I was like, this is it. And this is the asset class we're focusing on.
I like what you said. Would you rather lease a property to Arby's or lease a property to the employees of Arby's?
Yes, I love that. Yeah,
right?
exactly.
I mean, that's really what boiled down to exactly what you just said.
Yes.
Yeah, no, it's great. And they've got a business to run. They are highly invested in that thing, in that business, to make that thing go, to get it to work. And that thing, whatever piece of equipment breaks in the middle of the night, you don't get a phone call.
Exactly. And the other part I like is, so we do our due diligence to analyze the deal and make sure that it's going to be a nice long-term investment for us. But at the same time, we know, Arby's and Starbucks, they have their own real estate team that they've already analyzed the location of that property, because from a business perspective, they need to make sure they've got enough customers that are coming in and going to make them a profit, make them money, and in turn, be able to afford the rent that they're paying for that spot. So, we're going to do our due diligence on our side to make sure it's a good investment, a good location, but really we know that they've already, checked out the location as well.
Yeah. All right. Since you have last been on, what's changing your world?
Yeah, we just continue acquiring more. So find some opportunities out there. And right now, I think in the last 12 months, probably some of the best properties we've acquired are the best deals as far as returns go, types of properties, things like that. And even right now, some of them on our radar. I think it's just there's a good opportunity because there's a lot of inventory out there. There was a period where it was a little tight and banks were a little tough on lending. So it was harder for some investors to get the right financing to make a deal work. Right now, we're seeing banks with more liquidity, banks willing to stretch a little bit farther to get, whether it's a new customer or a long-term relationship, and really just kind of go to bat and be a better partner to make these deals work and to get some things moving. Nobody likes it when all of a sudden everything's on pause on the buy and the sell side. When things are on pause, nothing's moving in the economy. And so I think right now we're just in a point where, things are flowing a little bit better.
Yeah, it seems like the banks have filled up their coffers maybe a little more with cash. You remember the time you call 5 banks, there might be 1 for sure, 2 just going, yeah, we can't lend right now on anything. We're out of money. We're tight. It seems like that has changed, and they're a little more aggressive's not the word, but they're back in. They're more active.
Yeah, I think the other unique thing, the banks are going to deal with, and I don't think maybe there's time in history they've dealt with this, is they still have a lot of notes on their balance sheet that are in the 3 to 4% range.
Pre-COVID.
Yeah, right. So 2020 to 2022, that depends if people did a 5 or 7, or maybe even there's some 10-year stuff out there at 3%, right? And so those are sitting there, and now they've got a tranche of them that are between 7 and 8. Right now, with the Fed drop recently, people are getting money somewhere 5.5 to 6.25, and it's like, so they're navigating. All right, how do we do this? What are we doing with refis and everything in between? So, it doesn't make their job any easier. That's for sure.
It doesn't make it any easier. What I noticed is when we were getting 10-year money sub 4, guys were a little looser with their prepays. And, in the last few years, when you're borrowing money at 7, they're not as easier with their prepays. They're going, okay, let's make sure we lock in these prepays, because if things float downward, we want to make sure we get some fee income out of this thing.
Yeah.
To float our 7 down to 6 or whatever the number happens to land at.
Yep. Yeah. That's what we're seeing. Maybe a little more on the origination fees and, trying to just protect themselves so people aren't just shopping around nonstop. And I think that's where the relationships come in of, knowing that, all right, we got to stay competitive. We've got to, maybe do some adjustments as things come down, but make it fair for everybody. And I think that works out well.
Yeah. Give me a couple of the names that you acquired over the last year. Names that people would know.
Mammoth Car Washes, Pancheros, local to Iowa here. Jersey Mike's, love them as a tenant. They're a great tenant.
Great stuff, man.
AT&T.
Okay, yeah.
I love that. That was an acquisition that actually might be one of our best ones. And it was so I'll just dive into that one specifically. Yeah. Short-term lease left. Most investors probably would have passed it up because of the short amount of lease term left on it. But I just knew, inner city is a tried and true property, high traffic location. No matter what, whether they renew or not, it's going to be a highly sought after piece of real estate. And, within a week of closing on it, I get an LOI from another national chain saying, we want this place, and with above market rent and everything else. And then 2 weeks later, we get another LOI from another national tenant wanting this property. And it's like, geez, we got in. And so, I'm sitting here looking at 2 LOIs of great tenants that are wanting a property that's still, with a lease on it, and hopefully they renew and stay there, because we like to keep long-term tenants, but we know we've got other people lined up and interested in as well.
Hey Iowa investors, this is Ava Baukamp, Chief of Staff at Legacy Impact Investors. Have you thought about adding real estate to your portfolio but don't have the time or desire to play landlord? At Legacy Impact Investors, we do the heavy lifting. Our team finds the deals, manages the properties, and handles all the day-to-day operations. Our select group of qualified investors co-invest with us, gaining ownership equity without opening a tenant email or responding to a maintenance call. They just share in the income, appreciation, and tax benefits. These opportunities aren't for everyone. They are for qualified, accredited investors only. If you want to learn more, please visit LegacyImpactInvestors.com to apply.
Are there times when you're evaluating an opportunity where you're really evaluating the lease, the likelihood of the lease, what's their probability of surviving, of paying through the lease term as they agreed to, or versus you're analyzing the real property to go, it doesn't matter if this person stays or go. I know that real property, just like you described in the AT&T situation, is going, that's fantastic. It's a piece of real estate that I'd want to own, versus, the other side just being, great, the lease has got to perform because I know when I go back and re-tenant, it may not be as strong, or it's a bigger question mark.
Yeah, it really depends. But most of the time we are focused on, what is that return on the current tenant with that due diligence. We look at, a lot of people will look at that weighted lease term of what's left, especially in a strip center. So we just acquired 3 strip centers earlier this year. And again, most investors probably would have overlooked them, or maybe probably would have said, well, it ain't quite worth what we paid or whatever, because the weighted average lease, minus a couple of the anchor tenants that had 10-year leases left, a lot of the smaller ones might have had only a year or 2 years left on their term. And they would look at that and say, oh my gosh, there's just not enough left on there. They want that comfort and that risk. So that's looking at the weighted average lease term that's left. And so what I also look at is what's the lease like, what's their tenure? How long have they been there? And so even though they only had 1 or 2 years left, some of these tenants have been there for 20, 25, 30 years.
And you're thinking, this is a positive.
Yeah, because I'm like, they're there, they're established, they've got established customers that know, and this is exactly where they're going, their neighborhood spot that they're going to go and support. And, the nail salon's been there for 30 years, My mom's not going anywhere else to get her nails done. Right. She's going there. She's been going there for the last 30 years. And she's going to continue to go there, for the next 30 years. Yeah. So those types of things, I think, can get overlooked, where they don't realize, and if someone's established in there, changing an address for business is a pain in the butt. And now the other part is the cost of build out. So for somebody to move, because construction costs are so high, they don't realize cost to move and then have to build the space out custom to them. So the more customization to that build out for the tenant, the harder it is for them to move.
Or one of the reasons you stay away from office.
Yeah. Yeah. And I don't know. We've got some office in a few of our strip centers, like an Edward Jones type office. But again, those are, I walk into those and it's an immaculate office build out. And I'm thinking, well, these guys aren't going anywhere because the office looks so great. It would cost them a fortune to go to another one. And I like that those are smaller offices. So, instead of a big multi-story office building where it's all office, I think it's a good mix. And so, I don't have any, full office buildings.
Let's talk about rates. So, the Fed announced 25 basis point cut, says, hey, you can expect 2 more rate cuts this year. What do you think that does for the attitudes of investors and then sellers?
I think it pulls a lot more investors off the sidelines. I think a lot of people are kind of waiting and seeing for a while, or just, make some of the deals that you couldn't pencil. You needed that extra quarter, half point, just to make it happen. For the sellers currently, I think that, gets them, so the hard part with sellers is you got a lot of hungry brokers out there, and things dried up for a while. And so they're out there fishing and they're calling sellers. And, especially when you talk about the big nationals that are, just cold calling, right? And they're promising, a 2022 sale price. And the current market isn't commanding that. So there's been a lot of listings the last 12 months where we're probably overpromised by the broker.
I know the brokerage firm.
They're sitting on the market then, and it's crickets.
Right.
And now the seller's saying, wait, you said I could sell for this, and it's been on the market for a year and nobody's called.
Right.
Because there just wasn't that spread between, cap rate and, where we're getting financing at. So now I think we're starting to see that spread gap, get a little bit more favorable in the buyer side. So I think some of those sellers, we're going to get closer to, and they're, if it's been sitting for a year and there's been no offers, they may be willing to do a little price drop. They may be willing to negotiate a little bit more to get it where it's a win-win for both sides.
My hope, and I'm curious about your thought on it, my hope is that, yes, it creates more velocity, that more sellers come off the sideline. We're not getting back to 22 prices, maybe ever, well, not ever, but not for some time, because we're not going back to 3% interest rates ever, but certainly for some time. It's just every year that goes by, it seems like sellers get a little more realistic to go, okay, well, we're not going back to that number. So this is the new reality for the situation. But if rates come down, things get a little more attractive.
Yeah. So I see two spots, exactly what you said, where the rates come down, it's a little more attractive. So they're seeing the timing a little bit better to say, all right, well, this makes more sense to list it now. The other part, if we've got sellers who had, 3% financing from 2020, 2021, those 5-year notes are now coming due anytime in the next 12 months. So all of a sudden their rates are going from 3% up to 6%. That may say, well, there goes my cash flow. We're going to sell this thing. And even if they can sell it at where they bought it at or somewhere close to there, they may, dispose of a property and move that money and that equity on to another project.
That is the unique thing about commercial real estate, is the fact that most of the loans are done on a 5-year basis, that you've got a balloon that comes due and you do have to make a decision of some nature. The loan, you're going to refinance, and as you said, your cash flow may be gone, which means you got to do a cash in refi, not a cash out refi.
Yeah.
You want to keep that property. Here's the coverage ratio must be a 1.25 or 1.2, whatever the ratio is by the bank. And you don't have it given today's new interest rates.
Yeah. So then the investor will look and say, well, what's my return on equity, or what's my return on this investment?
Right.
So, well, it'd be better to sell it right now. And if we can get what we paid or maybe a little less, we paid down quite a bit of equity over the last 5 years, made some cash flow, but, take that capital, put it into another project with different capital stack. I think that'll drive up some activity.
That, and then, you've got the what's now permanent, 100% bonus depreciation has now been made permanent.
Yeah.
Tax bill. Not to say that everything trades off just tax, but certainly when we went from last year's 40%, now you're back to 100. It does spur interest, certainly on the buy side, of people wanting to place and in some cases having to place capital someplace.
Yeah, for sure.
If you're a house flipper, execute the burst strategy, or do double closings and are in need of money, Little Guy Loans is your go-to lender here in the Des Moines area. Time is money. Loan approvals in 24 hours. Closings in 5 days. Little Guy Loans was founded by Neil Timmins, an investor just like you. Since he has been in over 10,000 homes in Des Moines, there's never an appraisal. Houses, multifamily, and commercial property loans up to $1 million. Check out www.littleguyloans.com.
What are you most excited about next year, 2026?
I think that just that increased activity, things start moving on both sides. It just, it just keeps that velocity going, opens up new things. I think there's still, that transition of notes that are coming due and people having to make decisions. I think there's also, just a continued transition of, family, properties where, the dad may have been passing them down to the kids, or, you got a lot of baby boomers passing away, and these properties are going into estates and getting passed down. And at those point, we're seeing properties come available that have never sold ever. They've never been on the market. The dad developed it 30 years ago. And so we're starting to see what I call legacy properties come up and available. And, I think every year we're going to see more and more of those as baby boomers get older. Oh gosh, there's a lot of different ideas. I think just thinking of all the opportunities out there and different things that we've got going on, and how we can, continue the momentum that we got going.
What percentage of your properties are in?
28 out of 31.
28 out of 31 properties.
Yeah. And hopefully soon all Iowa. We've got we've got 2 outside of 27 out of 31. We've got 2. We got one in Scottsdale, Arizona for sale right now. We've got another one in Wisconsin for sale. And the other 2, the one in Illinois and the other one in Wisconsin, most likely we'll have for sale in the next year.
Motivates you to be a seller?
Just get that equity, move it into some other projects. Some of them there's certain projects we have in our portfolio that are legacy long-term projects that we know, okay, this property is going to be passed down to our kids someday, grandkids, whatever. Like, this is a do not sell property. Then there's other ones, especially the strip centers, where we know that, all right, we're going to add some value here. We're going to redo the facades, get some re-tenant, some different things, restructure some leases. So we have a few where the leases are really mixed up, where there's a triple net lease, there's a modified, there's a gross lease. And so those, we have specific plans for, where it's like, all right, this is a 2 or 3 year property. We're going to, work through these different things and increase the value, and then take that equity and the capital that we make from that and put it into some more longer term legacy stuff. And then we've got a handful of properties that we've purchased in a fund or a syndication. And with those, we have a designated timeline of 10 years, or, if the timing of the market's right and it's year 8 or 9, but we've got a pretty definite timeline on those. So that's just kind of how we have different ones spaced out, and we kind of have each property like a pretty good action plan before even buying it. Like, all right, here's the plan for this property. And then we just work through that plan.
I always learn something every time we talk. It's been fantastic. Well, I asked lots of questions. What's one question I did not ask that I should have?
Gosh, why Iowa? Maybe why Iowa?
Yeah, I mean, you're here. You're like practically all in.
Yeah,
right. I mean, you're in. This is your.
Yeah,
place.
and that's why we're selling the other ones. Yeah. Really, some of those were planned to sell at a certain point, but now it's just keep focusing on Iowa. And one of the reasons for that is, we're the other business we're running 1-800 t-shirts. We got 40 employees and been doing that for 20 years. And there is a lot of moving parts there. And with the real estate side of things, it was like, how do we make this as simple as possible? And what we discovered is, like, whether we're working with our accountant or lawyers or brokers or anyone else, every time you add another state or other stuff to it, like, it adds another variable complexity to it. And so, once we hone in and say, all right, we're going in all Iowa, that just like simplified a lot of things, especially on the buy side with brokers. When we're working with different brokers, like, all right, what's your buy box? We're like, okay, Iowa. I'm like, they're like, wait, nobody ever has said that to us before. Right. Usually they say Midwest, or they'll say, all right, I want something Iowa, Missouri, Minnesota, Wisconsin, whatever. So they give a much more broader thing. So when we narrow it down and we say, we're so narrowly focused on Iowa, when they see something pop up in Iowa, they're calling us first before they even get it listed. So I think that just helps on some of those opportunities. I also, a lot of these guys on the, investors and stuff, East Coast, West Coast, Iowa's a flyover state for them. They don't know where it's at on the map. They may have heard of us, but they just think it's all cornfields.
Well, they think we grow potatoes.
Yeah, exactly. So that's where, we'll be that little hidden secret here, and continue investing, right where we know the type of people that are supporting the tenants that we have. We know the people that are managers and employees and running those businesses. So it puts a little extra faith in, the real estate itself when we know what's happening with those businesses and those neighborhoods and everything around them.
I love the fact that you are so far and focused here in the state. It does make things so much easier, the simpler you can make it.
Yeah.
For people that want to find you, follow you, connect with you, where can they go? What should they do?
They can find us on Instagram at Fast Food Landlord. And I'd love to give a free thing to any listeners. So if you go to fastfoodlandlord.com/free guide, we got a free guide for showing people how to invest in triple net lease commercial real estate.
Perfect. Links below in the show notes for anybody and everybody. Check it out there. Tom, thanks for being here.
Thank you.
Thanks for listening. If you're enjoying the show, may I ask a favor of you? Naturally, subscribe so you never miss an episode. But would you rate and leave an honest written review on Apple Podcasts? It does a lot for us here at the show, and I appreciate reading your thoughts. Great guests make for a great show. If you know of another Iowan who would be a great guest, or you yourself have interest in being a guest, well, get on our radar. Visit Investing in Iowa to fill out an application or recommend a guest. And if you want to connect with me one-on-one, go to LegacyImpactInvestors.com. Click on the Invest With Us button in the top right corner, and there you can pick a time for the two of us to get on the calendar and connect. Until next time, keep investing in Iowa.